My first trade with my own system lost money. 22% of what I put at risk gone. And I take that trade again tomorrow. That sounds like code, but it isn't, and I can prove it because I wrote down exactly what I expected to happen 8 days before it didn't. So we're all going to be wrong. That part's not up to us. What is up to us is what being wrong cost. Most trading channels show you entries, and entries are free. Anyone can point at a chart and say what they'd buy. I'm going to show you exits. That's where the money actually is, and that's the part that nobody filmed. So here's the trade in one sentence. Cheap Japanese money is quietly funding risk all over the world. And if it stops being cheap, everything gets sold at once, and crypto gets sold first. For about 20 years, Japan has had the cheapest money on earth, rates at basically zero. So big money borrows yen for almost nothing and buys assets everywhere else with it. US stocks, bonds, crypto. It's called the carry trade, and there are trillions of dollars riding on this carry trade. And that works fine right up until the yen stops being cheap. If Japan gets forced to raise rates, say to defend a currency that's falling apart too fast and getting too weak, all that borrowed money suddenly costs more. And here's the part that matters. When your funding gets expensive, you don't get to sell your worst positions. You sell what you can right now. That is a forced seller, and forced sellers don't care about price. So the bet was the yen snaps, the borrowed money gets called in, and the first thing that's sold is whatever trades 24/7 with no closing bell to hide behind, and that is crypto. And we'd seen this movie before. Back in August of 2024, the same setup, Bitcoin fell about 15%, and the Japanese markets fell about 12% in one day. So here's where it stops being a vibe and becomes a thesis. A vibe is, I think crypto is going down, and you can't be wrong about a vibe. You just quietly stop mentioning it. And what I wrote down was a disorderly unwind of the yen carry trade within 90 days forces global risk deleveraging, and Bitcoin falls at least 20% from where it was the day that I entered, before my option expires. Direction, size, deadline, mechanism. A stranger can read this a year later and tell you whether I was right or wrong. This is the entire difference. Before I put a single dollar in, I had to write down 3 things that would prove me wrong. And also 1 thing that would tell me the crowd had caught on, and that would be my take profit point. So if the Bank of Japan explicitly signaled pause or hold through the catalyst window, or the second invalidation point is if the CFTC commitment of traders speculative JPY net short collapses below the threshold without a risk asset sell-off, which is kind of what happened in this scenario. We did not see a disorderly unwind. Actually, we saw a very well coordinated government intervention, which led to not a disorderly unwind, therefore invalidating my trade idea. So this right here isn't me remembering what I thought, it's a timestamp. It's a timestamp, and I couldn't edit these after the position went live, even if I wanted to. This system freezes them the moment the trade is real and holds me accountable to myself, to my trade idea. And also, the risk budget was set before I entered too. I paid about $150 in premium to test out this system to minimize myself in the decision-making process and have this AI-assisted tool help me. So whatever happened next, regardless of the outcome, the most I could lose was decided by me before the trade even took place. And so here's the strange part. I was right about the cause and wrong about the effect. The yen did exactly what I said it would. It ripped. So, I mean, in this chart, it's going down because it's USD versus yen, but this is the yen strengthening against the US dollar, ripping about 5% in 3 sessions. And this was a huge move for a major currency. And after this move, crypto did nothing. So because the unwind was actually orderly, intervention stepped in, the Fed's repo facilities soaked up the funding stress, and the whole thing got walked down the stairs instead of thrown out the window. My thesis didn't need the yen to move. It needed the yen to move chaotically, and it didn't. So that left me with the problem. None of my 3 exit criteria had truly fired. So by the letter of my own rules, I could sit and wait. But I could see clearly that the trade was dead. The chain I'd drawn, yen spikes, funding squeezes, forced to selling, crypto craters, that was actually broken at link 3. There was no forced selling, and the thesis with the broken link isn't a thesis. It's a wrong one. So I overrode my own system. I closed this trade and kept about 78% of the premium. My system grades every trade twice. One on outcome, did the money work out? In this case it didn't. I took a haircut. And one on process, did you follow your own rules? The outcome was a D because obviously I lost money, and the process was a B, not an A, because I did override my own criteria, and it doesn't just let that slide because I had a good reason. It made me write the justification down before it would let me close the trade. And that justification is here on public record permanently. Alternatively, a bad process with a good outcome is the dangerous one. That's how people learn the wrong lesson and blow up 6 months later. This was the opposite, and I'll take this every time. So having a bad outcome with a good process, in this case, I'm totally happy with it. So everything I just told you in this video is here on public record, public receipt here on the site with the timestamp on it, links below, check my work, because here at Tally, we're keeping score.